Hello, and welcome to this webcast about our project Lack of Exchangeability and the issuance of final amendments to IAS 21. My name is Jenifer Minke-Girard, and I'm joined here today by Rashida Abdryashitova. We are both members of the IASB technical staff. Please note that any views that we express here today are our personal views and are not necessarily those of the IASB or of the IFRS Foundation. So today we will provide a brief overview of the amendments to IAS 21. Before we discuss the amendments themselves, Rashida, can you please explain a little bit of the background?
Thank you, Jenifer. So why did the IASB decide to amend IAS 21? IAS 21, which is the IFRS accounting standard that looks at the effects of changes in foreign exchange rates, requires a company to use a spot exchange rate, that is, the exchange rate for immediate delivery, to report foreign currency transactions, present financial statements in a different currency, or translate a foreign operation. This project started from a question submitted to the IFRS Interpretations Committee. The submitter asked how to determine the exchange rate for a company to use to translate results of a foreign operation in Venezuela. The circumstances in Venezuela, described by the submitter, were such that the foreign operation's functional currency was subject to a long-term and not a temporary lack of exchangeability with other currencies, and exchangeability had not been restored after the end of the reporting period. Before these amendments, IAS 21 provided requirements for when exchangeability between two currencies was temporarily lacking, but was silent when a lack of exchangeability was not temporary. Although circumstances in which a currency is not exchangeable into another currency might arise relatively infrequently, when they do happen, economic conditions can deteriorate rapidly. In those circumstances, stakeholders' diverse views on the application of the IAS 21 could have led to material differences in affected companies' financial statements. The IASB therefore decided to take on a project to fill this gap in IAS 21's requirements. The project's objectives were to improve the usefulness of information provided to investors and to reduce diversity in practice by requiring companies to apply a consistent two-step approach that we will now discuss. Jenifer, can you please briefly explain the two-step approach?
Absolutely. So in the first step of the two-step approach, a company assesses whether a currency is exchangeable into another currency. And if the company concludes that the currency is not exchangeable into the other currency, in the second step, it would estimate the spot exchange rate and provide required disclosures. So I will talk a little bit more about step one. So this slide sets out the definition of exchangeable, that a currency is exchangeable into another currency when a company is able to obtain the other currency within a time frame that allows for a normal administrative delay and through a market or exchange mechanism in which an exchange transaction would create enforceable rights and obligations. The company would make this assessment at a measurement date and for a specified purpose. If the company is able to obtain no more than an insignificant amount of the other currency at the measurement date for the specified purpose, the currency is not exchangeable into the other currency for that purpose. The amendments do include application guidance and illustrative examples that will help companies make this assessment. So Rashida, can you please talk a little bit more about the purpose for which a company obtains another currency?
Sure. In assessing exchangeability between two currencies, a company considers the purpose for which it obtains or hypothetically might need to obtain the other currency. In some jurisdictions, different exchange rates apply for different uses of a currency. For example, a company might be able to obtain another currency to pay for imports of particular goods, but not to pay dividends. In developing the amendments, the IASB built on the requirements already in IAS 21 and decided that when a company reports foreign currency transactions, it would assume that its purpose in obtaining the other currency is to realize or settle individual foreign currency transactions, assets, or liabilities. When a company translates the results and financial position of a foreign operation or uses a different presentation currency, it would assume the purpose in obtaining the other currency is to realize or settle its net investment in the foreign operation or its net assets or net liabilities.
So let's move on to step 2, which is a company estimates the spot exchange rate when a currency is not exchangeable into another currency. So how would a company do that? A company's objective in estimating the spot exchange rate is to reflect the rate at which an orderly exchange transaction would take place at the measurement date between market participants and under prevailing economic conditions. The IASB's approach in providing an estimation objective, but not including detailed estimation requirements, reflects its view that estimating a spot exchange rate can be complicated, and it depends on entity-specific and jurisdiction-specific facts and circumstances, and that the economic models a company might use to estimate the spot exchange rate are varied. So Rashida, what else can you tell us about estimating a spot exchange rate?
When a currency is not exchangeable into another currency, a company would not necessarily need to use a complex estimation technique to estimate the spot exchange rate. For example, a company can use an observable rate without adjustment as the estimated spot exchange rate if that observable rate meets the estimation objective. The application guidance includes examples and factors for a company to consider when determining whether to use an observable exchange rate without adjustment. Or a company can use another estimation technique. For example, the company could start with an exchange rate it can observe and then adjust that rate as necessary to meet the estimation objective. The application guidance added by the amendments states that a company using another estimation technique may use any observable exchange rate, including rates from exchange transactions in markets or exchange mechanisms that do not create enforceable rights and obligations, and adjust that rate as necessary to meet the estimation objective.
Thank you, Rashida. That's very helpful. So now let's talk about disclosures. The IASB has added new disclosure requirements to be provided when a company estimates the spot exchange rate because a currency is not exchangeable into another currency. The new requirements provide a disclosure objective and specific items of information to be disclosed. The objective is for a company to disclose information that enables investors to understand how the currency not being exchangeable into the other currency affects or is expected to affect the company's financial performance, financial position, and cash flows. A company would disclose the information specified in the requirements and any additional information necessary to meet the disclosure objective. The IASB observed that some of the disclosure requirements are similar to those in other IFRS accounting standards, and a company might already provide some of the information when applying those other standards. So it may be helpful to know that a company need not duplicate information that it has provided elsewhere in its financial statements. So Rashida, when are those amendments to IAS 21 going to be effective?
The amendments are effective for annual reporting periods beginning on or after the 1st of January 2025, with early application permitted. The amendments outline specific transition requirements that provide relief from retrospective application. We won't discuss those in detail here. Companies should read those requirements carefully. The IASB developed those transition reliefs because it concluded that the expected benefits of requiring companies to apply the amendments retrospectively would not outweigh the costs.
Thank you, Rashida. And with that, we will conclude our webcast. So thank you for listening, and we encourage you to read the new requirements. Goodbye, everyone.